the NASDAQ is the lone gainer. It's up by about 0.1%. The Dow and the S&P 500, though, they are in negative territory, fractionally trading lower here on a percentage basis. The Dow down by about 0.6%, S&P 500, 0.3%. We are just 5 days into September, at least on the calendar, and it's already been a roller coaster, folks. Weak econ data, interest rate speculation, and big tech woes. They have whipsawed the market these past few days. For some investors, it's a major deja vu of August's brutal sell-off, and it's hard to determine where the market is heading much. So with so much uncertainty over the next few months here that we are trying to navigate through, here with tips on navigating that market uncertainty, I'm joined by Ken Mahoney, who is the Mahoney Asset Management CEO. Ken, great to have you back on the program here with us. All right, so you got to have some Dramamine to begin months, August and September here. Where are you finding a little bit of faith, at least right now, even as there were some dips once again to begin September, a month that historically has some cyclicality and known to be one of the underperformers?
Well, first off, as far as Dramamine, that makes me sleepy, Brad, so I'm not going to go near that stuff. It definitely needs something for the roller coaster, which September is the worst month since 1972, all these years. So something about the September. But, again, I actually see something a little bit positive happening here. We've been overweight technology, like probably most money managers, with the Mag 7 for a long, long time. The criticism about the market was too narrow, but it is broadening out. Now we're going to have rate cuts starting September, maybe 25 bips, maybe 50 bips, but quarter. We think by, let's say, March or April next year, we may be 3.5% Fed fund rates, and that spreads out, I believe, more opportunity for more stocks. Hey, we're growth managers, Brad, but we don't mind some of these companies that are embracing technology to help out their top line and bottom line. I think Walmart is like a poster child. Again, we're growth managers, so I say Walmart, but their online sales is 20% up year over year. These companies are now getting a lot more data, great data dives into logistics, inventory, the customer behavior, and so forth. You mix it all up, and now we're trying to find companies that are going to benefit from all this technology.
Okay, so being that you are a growth manager, let's summon back this term into the chat that our viewers have heard us use time and time again, or at least more recently as it's come up in conversation, GARP, growth at a reasonable price. Where are those opportunities that you're seeing in the market?
So it is difficult, but again, within that, we still like technology. It's equal weight instead of overweight. I mean, the video right now obviously has been struggling. By the way, Justice Department was investigating, not investigating it. There's a crazy story around there. But again, the top line growth is still astronomical. Of all the big techs at this point we like, I would say is Apple. Apple with their buyback program, 2.2 billion devices. You can really monetize a place when you have 2.2 billion devices out there. Big upgrade cycle coming with AI. In fact, in September, coming up pretty soon, obviously. But in addition to all that with Apple, what makes it so unique with the 2.2 billion, 300 to 400 million phones out there, they're almost obsolete. They're going to have to join the upgrade cycle. So of all the different ones that are out there, the Mag 7, Apple's our favorite, huge upgrade cycle happening, 2.2 billion devices, and you can monetize that pretty readily.
And so with all of this in mind, you also say always have cash to be ready for opportunities here. Within the dip buying mentality that has reemerged, where are some of those dips that you're expecting could see some massive inflows from investors?
Right. So I think most of your viewing audience should really be looking at the VIX, the Volatility Index, where it's sat around 12 or 13, 14 in the summer months and kind of calm lake and everything was kind of cool. And then all of a sudden, whoosh, the Japanese stock market crash, Warren Buffett selling Apple shares, one thing after another. And we saw the VIX hit 65. That's pretty extreme. And by the way, the quick math on that, 65 times 3, that basically means that the market is expecting in the next 30 days from that point, a 19% difference, 19% up or 19% down. It's not going to happen. But now we see the VIX, even today, creeping through. We started off minus 5%. The VIX goes higher. So for your investors or your viewing audience, key in on the VIX. When it's calm, that's great, but eventually it's going to spike up again. That's when you take some chips off the table, wait for some fear to spike in that volatility index, and that's time to kind of do your bargain shopping. So again, I'm not saying the VIX has all the answers. I'm not saying it's going to give you direction, so to speak, but certainly any investor that's managing their own assets or doing the things they're doing really need to be looking at this volatility index. And now I look at it as here today, just reversed. again, getting some fear out there. There's something called an election. I don't know if you heard about that thing, Brad.
Every 4 years, right? It feels like there's a record number of people worldwide that are participating in polls in one way or another.
It's amazing. So anyway, so the volatility. So here's the thing: if you're 100% invested at all times, you can't. That August 5th, that big downturn, you can't take advantage of it if you're 100%. Again, depends on the person, but if you're 20 or 30%, we take a big dip down. Again, a la August 5th, volatility spikes, VIX spikes. Now use maybe 10 or 15%, keep some of your powder dry. But I see it over and over again. Investors get really upset. And I say, wait a second, what do you have in cash? They look at me, I have like two heads. No, we're all in stocks. But if you're all in and you're 100% in stocks, there's no flexibility, so you're supposed to buy in dips and sell in the rallies. Well, you can't do that if you hamstrung yourself to 100%, in stocks.
All right, Ken, always pleasure to get some of your insights here. Ken Mahoney, who is the Mahoney Asset Management CEO. Appreciate the time, Ken.